This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, having dealt with the main rules that apply to the assessment of property income, treating the rental income as included in the computation on an accruals basis, and deducting allowable expenses on an incurred basis. Having dealt with that, we now look, and you'll see here in section 4, at the first of a few very specific scenarios that we also have to be aware of. This time we're not just dealing with a furnished letting, but a furnished holiday letting. There, that very specific reference to furnished holiday lettings. Now, those will have to be specifically defined, and we'll see what classifies as a furnished holiday letting down here. But if it does, there are specific rules that apply, and many of these are beneficial. One or two are bits we've already seen. For example, the last thing we were looking at the end of the previous session was the new treatment as it's come in relation to finance costs, in relation to property income, and how it is that gradually from the 17-18 tax year through to the 2021 tax year, how what is happening is that the allowable deduction for that finance expense, principally a mortgage interest figure, is being disallowed. We're no longer getting that allowable deduction, and instead it's changing over to a tax credit, a tax reducer. But that tax reducer, reducing our tax liability, is only taken at 20%, therefore creating increased tax burdens for higher and or additional rate taxpayers. What we see here, we just see it here on the screen, just at the very end of the previous session, we also had the point, does not include furnished holiday lettings. So far as furnished holiday lettings are concerned, if you've got mortgages outstanding on them, you're paying interest, interest expense will continue to be an allowable expense in relation to them. There are other benefits that attach to the letting of a furnished holiday property there, most of which at this point we won't be able to fully appreciate, but I can briefly explain to you at this stage the benefits that derive. Okay, first of all, these special rules. The idea is, if you've got a furnished holiday letting, that rather more work may be done in relation to it, in terms of your tenants are not just coming in for 6 months, 12 months, and therefore they're basically left alone. All you've got to do is make sure you collect the rent and go around and check that they haven't wrecked the place every now and again. But there's very little else for you to do. Well, holiday lets could be for 3 or 4 days, for a week, maybe 2 weeks there. And you've got to look after the tenant. Things, again, linen and stuff has to be changed, new towels, etc., etc. There is work to be done. So the idea is that we're going to treat it rather more as a trade. Now, we'll still work on the same basis of assessment. Rental income accrued, less allowable expenses incurred there. But we get certain further benefits here in relation to the furniture. Rather than applying the replacement furniture relief that we saw earlier in our first session, we'll get capital allowances. Now again, as we said at the time, we've not yet dealt with those, but basically in chapter 5 what we'll see, certainly with the level of expenditure we'll be talking about, that expenditure on furniture and furnishings there will attract 100% relief. Effectively you'll be getting a full deduction in the tax year in which you incurred that expenditure. There won't be the restrictions that apply as they do to replacement furniture relief there. Income qualifies as earnings for pension relief. Again, that's a later chapter, chapter 10. We've mentioned about already personal pension contributions. One can understand the benefit of paying into a pension scheme. At some point you're going to retire, hopefully sooner rather than later. I wish. And at that point you'll hope to have built up a significant pension fund to keep you going happily for the rest of your days. Well, what happens is that when during our working time we pay into a pension scheme, there are restrictions as regards how much we'll be allowed to put in, and further restrictions on how much we'll gain tax relief on. So income that qualifies for the pension relief, to refer to as relevant earnings, is usually what you do for work, either employment income or your self-employment trading income. But as well as those two, as we'll discover, I'll remind you of again, don't worry, in chapter 10, is we're also able to add in and treat as effectively working employment trading income here. We can treat the income from furnished holiday lettings, any profits deriving from them, as going towards the overall amount of relevant earnings, relevant that is for pension contribution deduction, allowing therefore a greater amount to be paid into pension schemes, which will then attract tax relief. So good news for the taxpayer there. Possibly the main benefits, and again, as yet we won't appreciate, is to do with CGT, capital gains tax, where there's a variety of reliefs that will apply. First of those, it's dealt with, as you'll see here in Chapter 14, rollover relief. When you dispose of a property, there's hopefully a very good chance that you'll make a capital gain thereon. But having disposed of one property, you might reinvest the proceeds in another. And if you do that on qualifying business assets, we'll have to learn what they are in Chapter 14, then that allows you to take the gain that you have made on the sale of one asset and, using the term there, roll over that gain against the base cost of your newly acquired asset. You defer the gain made on the sale of one qualifying business asset by reducing the base cost of your newly acquired business asset. By making its base cost lower, when it is eventually sold, you'll have a lower cost to go against the same sale proceeds, and therefore the gain that will be bigger. So the relief rollover, as most reliefs are in terms of capital gains tax for individuals, it's a deferral relief. A gain that would have been assessed now is deferred until such time as you sell that replacement asset, that other qualifying business asset. Now, there mostly will be a gain to do with businesses, individuals that operate an unincorporated trade, but also for individuals, furnished holiday letting property will qualify as such a qualifying business asset. So again, we may be able to defer gains that arise on the sale of such a property if we then reinvest the proceeds in another. When you dispose of an asset, it's not just by means of sale. That's our natural first thought. But also a capital gain will arise on a gift of an asset. If that asset is a chargeable asset, as a property would be, then should you give it away to your kids, for example, rather than sell it to a third party, then a gain will arise based on its then market value. Clearly, with a gift, there are no sale proceeds, or if it's a sale at undervalue, they are deliberately low proceeds. We use open market value in computing the gain thereon. But if a gain, with a slightly different definition this time of, if it's a qualifying business asset that is gifted, then gift relief will again allow the donor, the person who makes that gift, to defer the gain. And again, it's in classic rollover form. It is deducted from the base cost of that same property that then goes to the donee. Effectively, the donor is able to pass the responsibility of the gain that he or she has now made based on the market value of the property gifted, take that gain and deduct it from the base cost to the donee. So the donee's cost is made that much lower. Should then the donee sell in the future, the donee's gain will be that much bigger. At that point, the gain will crystallise. Unless, of course, the donee in turn gives it away and he or she then too claims gift relief. Another deferral. Again, don't worry, I've talked through fairly quickly those. It is simply that we will be dealing with the details of each of those two incredibly important reliefs later in Chapter 14. But there are benefits to be had in relation to the disposals of qualifying business assets, and your furnished holiday letting here will qualify. And finally, entrepreneurs relief. If we are not able to defer the gains through either of rollover or gift relief, then the gain will become taxable. Now again, we do not yet know the details of how to calculate a chargeable gain, though for individuals it's a very straightforward exercise, or indeed then about the tax rates that apply. But put it like this, the tax rate that is applicable if entrepreneurs relief applies, it refers to it as a relief It is in fact a tax rate, but it's a lower tax rate. It's a 10% tax rate that will apply, whereas compared to a normal, and our hero here, no doubt our taxpayer will be a higher rate taxpayer, on most assets they would pay tax at 20% as a higher rate taxpayer, but in relation to residential property as a higher rate taxpayer, it would be 28%. If you're a basic rate taxpayer, if you have any basic rate band left, then it would be 18%. So the probability is on the disposal of such a residential property, if it was just a normal furnished letting or an unfurnished letting, you're a higher rate taxpayer, you make a gain, some of that gain is taxable, maybe most of that gain is taxable, you'd be looking at a 28% tax rate. Well, with entrepreneurs relief, again the idea is it's a trade, entrepreneurs trading, you get the link there I hope, that it is a trade, on that basis a 10% tax rate. Now that's incredibly good news, to think that when that property is sold, any taxable gain will only be taxed at 10% rather than the otherwise more likely 28%. Very significant advantage. So again, until we've looked at CGT, it's a little bit difficult, I understand, to get your head around those points. But again, be aware. All you need to be aware of at this point is these are the rules, that if the property is indeed a furnished holiday letting, this is what you may benefit from. Now, the lettings must be of either UK or European Economic Area. That's basically the EU plus 3 other countries, but you'll only have to deal with UK property so far as your exam is concerned. It's obviously furnished accommodation there, made on a commercial basis with a view to the realisation of profit. In addition, now then, the following conditions. This is the bit which again, not now, but closer to the exam, I'm afraid. There's no shortcut. You're going to have to learn it. For what qualifies as a furnished holiday let? The accommodation must be available for letting for at least 210 days in the tax year. Must actually be let, so available to let for 210, actually let for at least 105 days. If we're below that level, even though it's a furnished holiday let, you won't get this taxation treatment. And again, the idea is that it's a holiday let. So people come in for relatively short periods of time. Not like 6 months, or with a student maybe 6 months, 9 months there. No. So what you have is this one, that no one person occupies the property for more than 31 consecutive days. And if one or more persons do occupy the property for more than 31 consecutive days, then these periods of long letting must not exceed 155 days in the year. If they do, then this property is not a furnished holiday let, and this more favourable tax treatment will not then apply. Now again, it's no good if you're months and months away now from when you take the exam. It's no good trying to learn these tonight, as it were, or today when you're watching. But again, be aware that those are the rules. Practice them with little examples that you'll see, and that will help you to familiarise. But again, closer to the day, it's one of those learning exercises, I'm afraid, that only you can undertake for yourself. Okay, that's the first very specific area. Here's one that is rather more quantifiable and therefore maybe more likely to get an objective testing question upon it. What we've been considering up until now is that the property or properties being let are second and third or however many properties that the individual owns that they bought specifically for letting. But what you might do, if your house is big enough and you're willing to do it, is to rent out a room or rooms within your own house, within your own private main residence. And if you do that, again a term that you may be familiar with, if you take in a lodger for this purpose, then there are generous reliefs available to you. So it's called rent a room relief. So if an individual lets a room or rooms furnished in his or her main residence as living accommodation, then look at this exemption. Then gross rents up to £7,500 per annum are exempt. So, if you were so minded, you could let out a room in your property and you could have rents of up to £7,500, they would be exempt. If your rents go above £7,500, then either of two things can happen. You can have your normal ordinary calculation of a rental income assessment, rental income accrued less allowable expenses incurred, or you can elect for renter room relief, which will allow you to instead deduct this £7,500. So, the exemption may be ignored if the taxpayer wants to generate a loss where expenses exceed income, or as I've just exempted out, where actual expenses exceed £7,500. Again, if your income is below £7,500, then you would think go with renter room relief. Because if your gross rental is not in excess of £7,500, you are exempt. Doesn't matter what your expenses are, you are exempt. There is nothing assessable. So you'd think, yeah, I'll do that. But hang on a minute. What about if your rental income on such a room or rooms was £3,000, but your expenses were £4,000? With renter room relief, your income is 3, it's less than 7.5, therefore there is nothing assessable. But if you went with your ordinary calculation, rental income accrued 3,000, less allowable expenses incurred 4,000, that would give you an allowable loss that you'd be able to use against rental income either now or in the future there. You'd have a loss available. You wouldn't have that loss if you just went with the renter room relief. Equally, if you had a situation where you had rental income of, say, £10,000 in the year, either of two things could be done. You could take your renter room relief, and therefore you just automatically reduce that rental income, the gross rental income, by £7,500, and you would be assessed on the difference, the excess. Or you could do your ordinary calculation. Now, why would you choose to do the ordinary calculation? Only one reason, and that is that your expenses for this tax year are more than £7,500. If you've got expenses of 8,000, 8 from 10 is clearly 2,000. That's better than deducting 7.5 from 10 and being assessed, therefore, on £2,500. And that's the point here. If gross rent exceeds 7,500, the taxpayer may choose to assess as follows. Gross rent less expenses, and that will give you your property income assessment, your normal ordinary calculation. Alternatively, from whatever your gross rents are, you take away your 7,500 rent a room relief. The election must be made for our tax year 17-18 by the 31st of January 2020. Again, you don't yet know it, but for 17-18 you have to submit your tax return, your self-assessment tax return, by the following 31st of January, the 31st of January following the tax year. So that would be the 31st of January 19. So you've got one more year in which to make your mind up so far as the election is concerned. And then it stays in force, the rent a room relief, until it is revoked. Okay, you've got there a little example for Barbara. Rents a room in her main residence. Gross rents are £650 per month, and expenses amount to £1,200 within our tax year. Calculate Barbara's property income assessment, of course, for 17-18, and state the due date for any relevant election. Now, I just talked you through that, so hopefully you'll be able to work that out for yourself, and again, it should only take a couple of minutes. So in which case, if you again want to pause this lecture at this particular point in time, and then come back and join us and we'll move on to the next section. So if you're going to do this now, do pause, work the example, then come back to me. Okay, section 6 gives us a very different issue to deal with. It was mentioned right at the very beginning of the first lecture, the previous session, on this chapter. that although property income is usually and mostly ever made up of rental income, what we might also receive is a one-off premium, where a lease premium is received on the granting of a short lease. A short lease not more than 50 years. Now, we expressed at the time that when you receive this one-off payment, because it is one-off, then what we'll find in practice, depending on the length of the lease, is some part of that premium that you receive, this one-off payment from the incoming tenant, is some part of it is to be treated as income, and that's the bit we have to do now that is within our syllabus, while another part of it is to be treated as capital. That is not in our syllabus, not now, nor even indeed at advanced taxation at P6. So it's just the income element. So when a tenant takes on, so the tenant, a new lease, he may be required to pay to the lessor, the owner of the property, a one-off premium in addition then to whatever annual rentals there may be. If the lease is for less than or not more than 50 years, part of the premium is assessed on the landlord as property income, and the remainder is treated as a capital receipt. Thankfully, we don't have to worry about the capital component. That's the tricky bit. All we've got to deal with is how to work out the property income assessment. How do we do that? There's a lot of different ways. To work directly to the figure of assessable premium in relation to this premium received, we can do it this way. Take the total premium, there P, and multiply out by, on the top line, 51, this is 51 years, minus N, the duration of the lease in years, over 50. So the premium times what you have to learn then is 51 minus the number of years of the lease, divide by 50. That will take you directly to your answer. Many texts do it in a slightly different way, and we'll discuss that with a little example now. Again, that alternative treatment, it's written here, may be computed as the full premium received, and then you reduce that full premium by 2% of the premium for the number of years of the lease less 1. Now again, that's a whole load of numbers thrown at you. Let's just illustrate that with a little example. Okay, let's say therefore that A grants a 21-year lease on the 1st of July 2017 on receipt of a premium of £70,000. Very good news for A. Rental income is £20,000 per annum, which is paid by the tenant, by the lessee, monthly in advance. Now, as regards the rental income, now that's the bit that you should already know in working out now the overall property income assessment. First of all, always check out the date from which the property was let. This was the 1st of July 17, i.e. within the tax year. If it had been the 1st of July 2016, and we, as we will be, asked to compute the 2017-18 tax year's assessment, had it been let out on the 1st of July 16, then the full 17-18 tax year, the property would have been rented out. Therefore, £20,000 would be the property income assessment in relation to the rental income for the 17-18 tax year. Remember, whether it's paid monthly in advance, in arrears, quarterly, half, yearly, doesn't matter. We work on an accruals basis. So from the 1st of July 17 through to the end of the tax year, the 5th of April 18. So for 2017-18, our rental income would equal 20,000 times 9/12. It's 9 months from the 1st of July 17 through to the 5th of April 18. So for 17-18, the first part of our property income assessment would be 15,000. Again, of course, in real life, away from that rental income, any and all allowable expenses incurred would be deducted. But normally when you get a question of this nature, like a little 2-mark objective testing question, there's probably going to be no expenses to take account of. They just want to see whether you can work out the correct figure of assessment. Often when students do an example like this, what they focus on is the premium. Read the requirement very carefully. This is the problem with objective testing questions. You see the information and we assume then what the examiner wants us to compute, but it may not be that. Here, for example, what you might have in an exam question is they might ask you to compute the overall property income assessment, which is what we are doing here. They might ask you simply compute the assessable amount of the premium received. So be careful as regards what it is and give the answer to the question posed, not the one that you think has been posed. So the rental income bit, that's done. We've got 9 months worth of the annual rental income, and that would be the calculation. Again, remember, irrespective of whether the date, whether the rental income was due monthly, half-yearly, quarterly, whatever it might be, in advance in arrears. It's 9 months of the tax year the property is rented out for. It's 9/12 of the annual rent. And then the new bit, the premium. Right. In relation to the premium, we can go straight to the assessable amount by using that calculation. 51 minus n, the number of years of the lease. How long was it? It's a 21-year lease. Over 50. Oops. And that is, of course, times, how much was the premium? £70,000. Times 70,000. So 51 minus 21, that's obviously 30. 30 over 50, 30 50ths. So as a percentage, that is 60%. 60% of 70,000 is 42,000. So we are looking at a property income assessment here of 42,000 to add in the 17-18 tax year to 15,000. So if they want the property income assessment, that is the combination of 15,000 plus 42, some, what's that, 57,000 I think that will be. If they want the assessable part of the premium, so far as income tax is concerned, that is £42,000. Again, read the question carefully. Okay, now if I take you back to the notes, there we go. That's what we've just done there using that particular calculation. As I say, entirely up to you now as to which technique you use, which one you can remember best. That calculation takes you directly to the taxable, the income assessable part of the premium. Another way of doing it, as stated here, that you'll see in many of the texts from the ACCA approved providers, is this way. We take the full premium received and then reduce it by 2% for the number of the years of the lease less 1. So going back to our example, that was the direct calculation, the method I prefer to take you to 42,000, or we could pick up the full amount of premium received, that was £70,000, and then deduct from it 2% for the number of years of the lease, 21, minus 1. So whatever is the number of years of the lease, minus 1. Well, 21 minus 1 is 20. 20 times 2% is 40%. We're going to reduce it by 40%. 40% of 70,000 is 28, which of course will bring you back in turn to 42. So this technique here calculates that 60% of that premium is going to be taxable as income. 51 minus number of years of lease over 50 times the full premium received. This technique here takes the full premium and removes from it the bit that is not to be assessed as income, leaving you with what is then taxable as income. Again, entirely up to you as to which technique that you use. Again, each of those will bring you happily to the right answer. Okay. Going back to here, therefore, you've got a little example 5, which I'd like you, therefore, to have a little go at, look at and check through, of course, the model answer there and make sure that you're happy with it, and then rejoin us if you would. Okay, well, hopefully, therefore, you've worked through that example 5, checked it out with the model answer, and you're happy with the answer to that. Now, we've looked at the position for the lessor, the owner of the property who is letting out that property and receiving that premium receipt. What we may also have to do is to deal with the lessee, and that's what comes up here. Now, if the lessee is paying a premium on the granting of that short lease on a property that they use in their trade, and this is usually where you see this, if it is for their trade, then they will be entitled to a trading profit deduction. So if you are a business, an unincorporated trader, sole trader, a partnership there, if you pay rent in relation to your business property, clearly that is an allowable expense that will serve to reduce the profits upon which then you will be charged to tax. Your trading profit assessment is of course going to be reduced in relation to rental that is payable in relation to a property used in the trade. But when you first acquire that let property, you, the trader, may be required, if you want that property, to pay a premium. So does the trader, the lessee, get any tax relief in relation to the premium paid? The answer, as we'll see here, is yes, but not as a one-off figure, but instead as an annual trading profit deduction to be deducted in each year of the lease. So, where a trader has paid a premium, again for a short lease, not more than 50 years, the trader may be able to deduct then the following annual amount against their trading profit in each of the years of the lease in which the property is used in the trade. So that deduction is in addition to any rental that is payable for the accounting period as well. And the way that we do that is to go back to the figure that we've just computed for the lessor, the property income assessment on the landlord. So when the lessee, the tenant, pays the premium, not all of that premium payment is going to achieve tax relief against the trading profits made by that business. Instead, we restrict the amount of trading profit deduction to the amount of the property income that was assessed on the landlord, the lessor. But this is not a one-off allowable deduction. It is computed on an annual basis. We get a per annum figure by dividing out by the number of years of the lease. So, if you get a question that directly asks you this, you've got to do all the work that you did a moment ago in relation to the premium receipt and calculate the property income assessment on the lessor. Then divide that figure by the number of years of the lease, and you'll then have your annual trading profit deduction. So let's go back and look at the example that we did earlier, where what we had was A had granted a 21-year lease on the 1st of July 17 and received a premium of £70,000. we worked out how much in the tax year 17 he'd be assessed on in relation firstly to rental income. What is rental income so far as the lessor is concerned will be allowable rental payments so far as the lessee is concerned. They, of course, will be deducted in relation to the accounting period of the business. So when we look at the lessee, we'll be taking deductions not for tax years, unless the trader has chosen to prepare accounts to the 5th of April, which is maybe unlikely, but happens a lot in exam questions, to be fair. So we calculate the deductions for the accounting period. Any rental payments are allowable deductions. But then there is the premium. Now, we've already done the hard work here. The assessable premium on the landlord, on the lessor, is £42,000. So what we can now work out is the annual trading profit deduction to the lessee. This is the tenant there. The annual trading profit deduction to the lessee in respect of the premium paid will be, well, it takes rather longer to write out the question there than it does to do the answer. What was the assessable premium on the lessor, on the landlord? That was £42,000. How long was the lease? 21 years. Not -1, 21 years there. 21 years was the length of the lease. And of course, you can see with these rather contrived numbers, 42,000 divided by 21 is £2,000 per annum. So in each full accounting period in which the lease property is used within your trade, in addition to the rental payments that you've made on that property in that accounting period, you would also be allowed there £2,000 per annum in relation to the premium that you paid. Now again, if you are dealing with the accounting period in which the premium was paid, then you've got to be a little bit more careful. Watch out for this in an objective testing question. There, the amount is £2,000 per annum for each year of the lease. Now, when was this lease granted? The lease was granted on the 1st of July. Oops, where's that gone? On the 1st of July 2017, as I recall there, mysteriously disappeared. On the 1st of July 17. So if lessee prepared accounts to the 31st of December in each year, then what tax relief would be available? Well, it was paid on the 1st of July 17. So that, therefore, would be in the accounting year ended the 31st of December 17. The annual figure was £2,000. It's £2,000 per annum as the allowable deduction. But the lease was only granted on the 1st of July 17, so within the year ended 31st of December 17, there is only 6 months of that lease period. So that would be times 6/12, which would equal, therefore, £1,000. So when you were calculating, you'll be doing this in the next chapter on the adjustment of trading profit in Chapter 4. When you're calculating the adjusted trading profit for this year end, you have initially computed that the annual trading profit deduction is £2,000 in relation to the premium, but given that that premium was paid partway through this accounting period, we need to know how many months worth of this accounting period we actually had that leasehold property for, and that was 6 months. So £1,000 would be the allowable trading profit deduction in this year. Then from the year ended 31st of December 18 onwards, it would be £2,000 per annum for each full year in which, again, the leasehold property was used within the trade. Now, in relation to that little exercise, therefore, you've got here example 6, again for you to have a go at. Now, it references back to example 5 that I hope you've successfully already done. Do read the question carefully. It simply says, show the relief available for Richard for the premium paid. You will be working out the annual trading profit deduction. They haven't asked you here to show for Richard the allowable trading profit deduction in any specific accounting period, whether then you'd need to take account, as we have just done, of the date upon which the leasehold property was acquired for use. Okay, have a go at that and then briefly come back to join us for us to just complete this particular chapter. Okay, final little bit here in relation to this chapter. We came across ISAs, individual savings accounts, back in chapter 2, and where we saw them was under a list of exempt income. So if you receive interest income or indeed dividend income from shares or deposits held within an ISA, they are exempt from income tax. Income is free of income tax. Disposals of investments like shares held within, from which you receive the dividends, would also be free, exempt from capital gains tax there. Again, we'll see more of that when we come to capital gains tax later in our studies. No restrictions as regard a minimum holding period there, and you can make withdrawals at any time. We said when first discussing this that, again, any exemptions, of course, are very welcome. But since the introduction of the savings income nil rate band and the dividend income nil rate band, a lot of the benefits of ISAs have gone. Now, there are still advantages to be had here. If you are a higher rate taxpayer with significant amounts of interest income or an additional rate taxpayer with any interest income, then of course you're either not going to have any savings income nil rate band if you're an additional rate taxpayer, or you've only got £500 worth of such if you're higher rate. So if you've got a lot of income, then maybe this is worthwhile. Again, you can build up these deposits on an annual basis from which you gain that interest income. And when you come to sell shares, if you have shares within such an ISA, that if you had significant amount of shares held and you made significant gains on the shares when sold, they may be in excess of what we refer to as our annual exempt amount. This is the CGT equivalent of your personal allowance. The personal allowance was a level of tax-free income each year, and your AEA, as you'll come to know it, annual exempt amount, is a level of tax-free gains each year. So if you had lots of gains, then it's possible, of course, that yes, holding the shares within an ISA would be a good idea. This tells you what can be in it, and here we tell you what the subscription limits are, and the £20,000 figure quoted there is given on your rates and allowances, but you can read that through for yourself. National savings, again, we've been introduced to these back in chapter 2, just to remind you. They offer a variety of products, some of which are tax-free, exempt. National savings certificates there. National savings certificates. But some national savings products, national savings and investment products here, are taxable. And those are basically accounts, which might be, again, I think they changed the name now, but easy access or investment accounts there. Those are taxable. So if it's certificates, we are talking about exempt. If we're talking about accounts here, then it's going to be taxable. Okay, that's all out there for the property and a few other bits on investment income. In our next time together, when we start off on chapter 4, what we're going to see there is our introduction to dealing with trading profits, which in previous lectures, as I've already said, is a big area. And in chapter 4, we tackle the first problem. We were talking a moment ago in relation to a lessee paying a premium on the granting of a short lease of an allowable deduction against trading profits for an accounting period in which you used that particular leasehold property. But the overall problem of how do we take what is an accounting profit, which is perfectly fine in terms of accounting, and turn it into a profit that is acceptable for taxation purposes, and the figure of profit that will then be included in your income tax computation. That will inevitably involve an adjustment of the accounting profit. And that adjustment of trading profit exercise is what we do in Chapter 4. We look forward to seeing you then.